Hi friends, I'm Daniellecheche and we're back with the most beginner stock market tutorial there ever was. Let's jump back in. So as I mentioned in the first one, we're going to talk about how you can get paid, because why do this if you're not going to get paid, right? Obviously, you can sell a stock and hopefully make profit off of that, but sometimes companies are profitable and they've paid off all of their debt. What a dream. So they like to reward their investors. So in that case, they have 4 options moving forward. First, we're going to talk about when companies pay dividends. So a dividend is basically a reward for being an investor with a company. They'll pay out on a monthly, quarterly, or yearly basis. When a company like Coke or Costco pays out dividends, they're saying that they no longer have much room to grow, so they're going to pay out dividends to keep their investors happy. Stocks like this tend to be less volatile. Let's be honest, Coke and Costco probably aren't going out of business anytime soon, right? Side note though, if a company eliminates dividend payments, it's a bad sign. Companies that pay out dividends are mature and settled down. You're young and full of vitality though, so let's talk about stock buybacks. Companies do this to reduce the number of shares in the open market. It usually signals confidence in the future of their business. When companies do this, they pay market value for their shares to gain more ownership in their company, which was previously distributed amongst private and public investors. By doing this, it increases share price because there are less stocks available to the public. So, because the company is confident in its future, your stock price automatically goes up. Great, right? So now let's talk about some stocks that aren't as reliable. Penny stocks. So they're pretty good for day trading, right? You don't have to invest a lot and they're pretty volatile, so you can make some decent rips, but they're unpredictable. However, if you're looking for a long-term investment, I'd look elsewhere. Penny stocks don't have to meet the same requirements as companies traded on the NASDAQ and the New York Stock Exchange, so they're susceptible to price manipulation and should be avoided. Let's talk about stock splits. During a split, the value of the company never changes since we determine value by market cap and not stock price. However, the company looks more affordable to small investors, so people start buying. It makes more stocks liquid, which makes it more affordable for the little guy like us. So basically, your 100 shares at $20 turns into 200 shares at $10. But you still have the same amount of money in that particular stock, right? There's also a reverse split, which is generally used by smaller companies to seem more expensive and in turn more reputable. Same concept, but in reverse. You get it, you're smart. Finally, time for the important stuff. Let's talk about orders. All right, this is how you're gonna get rich, so pay attention. First, we're gonna talk about market orders. You wanna buy a stock right now? A market order is how you're gonna do it. Why did you get very New Jersey? That's so weird. Whatever. So this is how you buy and sell at the current price. It guarantees that you're gonna get a share of that stock at the current price, even if it's not your ideal price. Next is the limit order. This is where you set a price in which you wanna buy or sell a share. So if it reaches the price that you set, boom, you're in. And you're comfortable with that price because you set it at that price. If it doesn't reach your predetermined price, even if it's just a cent short, you're out of luck and it's not gonna fill your order. Let's talk about stop orders. Hi, Future Danielle here. I was just editing and I found a really long, confusing explanation of stop orders. So to place an order, it's also going to give you an option to place a stop order is the stop market order, which lets you sell when you've reached just a trigger to release your If you've placed a limit order, then it's so that's really similar to a stop market order, except I don't want to waste your time. So here's what you need to know. When you're placing an order, it'll also give you an option to place a stop order. It's just the lowest amount you're willing to lose before you get out. When you're short selling, it's the highest because you buy high and you want it to go lower. So if it continues to go up, you want to get out. All right, we're about to talk about margins, but before we do, we need to have a serious talk. Since my channel and my trades will be mostly day trading, we need to talk about the PDT rule. Oh, there's Harley. Peanut. A pattern day trader is an investor that executes 4 or more trades over the span of 5 business days, provided the number of day trades are more than 6% of the customer's total trading activity for that same 5-day period. Luckily, it only applies to margin accounts. So what is a margin account? It allows investors to buy stocks using borrowed funds. Neat, right? Maybe. So they tend to be a moneymaker for brokers, but they could put the little guy in big trouble. Obviously, it gives you the opportunity to invest with more money, which means bigger return. But as with everything, you could lose and still have to repay that money in full. That means your broker could, 1, force you to liquidate your margin positions before you're ready, which means you could take a loss. 2, they could force you to liquidate your other positions in your account in order to repay the loan, which again means you could take a loss. Obviously, you could also hit it big. Instead of having to chip away with small amounts of money, you could put more money in and get more money back. It's really just a personal risk assessment, so whatever you're comfortable with is what you should risk and no more. So basically, if you don't have a margin account, you don't have to worry about the PDT rule. If you do, there are some ways to get around it. Speaking of day trading, we're finally at our last topic of the day, short selling. It's a great method for day trading, but again, not a great method for long-term investing. You definitely don't want to bet against the company. When you short sell, you borrow a stock from your broker using credit. If a stock price drops, you can then buy the stock at the reduced price and make a profit on the difference. If you bet wrong and the stock price goes up, then you have to purchase the stock at a higher price to repay the owner. So when a stock is down for the day, but you see a little spike, there's a pretty good chance that it's going to fall again. So I like to take advantage and short sell at that spike. Caution, when you purchase a stock, you can only lose so much. A stock can't go below zero. When you're short selling, there's no limit to what you can lose, so be careful. Be sure to add a stop order so you don't end up owing your firstborn. He's not really my firstborn, but my firstborn's not as cooperative. So in addition, when you short a stock, you're not entitled to any dividends or shareholder rights because you're only borrowing the stock. Okay, well that's all. Are you with me? Did that raise more questions than it answered? Leave a comment below and I'd be happy to go into more depth. While you're at it, don't forget to like and subscribe. I'd really appreciate it. Next time, we'll be out of the most beginner topics and onto some more advanced stuff. I'll also be showcasing my potentially disastrous day trades. So until then, drink plenty of water and take your vitamins. Love you, bye. You're a good boy.